Did you know that the global silver market is entering the most dangerous period in decades? With China running out of reserves, the LBMA nearly empty, and the bullion banks racing to secure supplies before a silver default, the stage is set for chaos. Meanwhile, demand is hitting record highs while supply has been shrinking for the sixth consecutive year. A massive explosion is on the horizon, and silver prices could surge to unimaginable levels. Stay tuned for what comes next. New data shows that the remaining silver on the Shanghai Gold Exchange and the Shanghai Futures Exchange has dropped to its lowest level since Q1 2017. This reflects China both retaining its limited stock and quietly moving some abroad, including to the LBMA. Reviewing Nick Lehr's charts, Ed Steer emphasizes that China fully understands the market situation, and halting silver exports was only a matter of time. As predicted, this action occurred. After following Nick Lehr's charts and writing about them weeks earlier, Ed Steer stresses that China is fully aware of developments in the silver market due to its seat at the LBMA. He predicted that with reserves extremely low, China would soon halt exports entirely, which indeed happened on October 26th. Interestingly, their previous conversation was on August 22, and just one day later, silver prices began to fall. The market had been in a strong upward trend until about a week earlier, when commercial traders entered the market, especially on Friday, September 17, immediately halting the rally and creating a key turning point in silver price movements. Beyond debt, Ed Steer notes many factors heavily influencing silver. Rumors of an interest rate cut in October and speculation about another in December, though uncertain, affected the market. Combined with debt pressures, monetary policy, and global volatility, currency values weakened, creating a highly unstable environment. Steer calls this the final stage of the road to perdition, implying the current monetary system is nearing collapse. In this context, gold and silver surged as more investors realized what was truly happening. Even major institutions like JP Morgan and Morgan Stanley allocated 10 to 25% of their portfolios to gold, highlighting the seriousness of the situation. Ed Steer emphasizes that silver is in a structural shortage, which contributed to the recent strong rally. However, intervention by bullion banks disrupted the natural rise. He explains that the correction was not a genuine market correction, but a manipulated price suppression. Without institutional intervention, gold and silver prices could have risen to extraordinarily levels. At that time, the market was responding not only to inflation concerns, but also to actual supply constraints. Ed Steer explains that without intervention from bullion banks and other market manipulators, gold and silver could have advanced much further. He describes the recent correction as a fake price fix, not a natural adjustment. The market faces a severe structural silver shortage lasting 5 to 6 years, now beginning to reflect in prices. Data show mining output cannot keep pace with rising industrial and investor demand. Notably, about 75% of silver comes as a byproduct of mining other metals, so even rising prices don't expand supply significantly. When monetary instability combines with true supply constraints, the market forms a solid foundation for higher silver prices. Ed also notes the recent surge shows signs of a short squeeze, though incomplete reporting prevents full confirmation. Nevertheless, the market is clearly shifting in silver's favor.
Ed Steer notes that the silver shortage has persisted nearly 6 years and is increasingly visible in prices. The recent rallies show signs of a short squeeze, but the U.S. stopped publishing commitments of traders reports after September 23rd, leaving market mechanics unclear. He observes strong short covering activity, especially in gold, indicating much of the rally came from speculators closing massive short positions. Bullion banks had to intervene because Ted's fire, the explosion of trapped short positions, was spreading. Without their intervention, gold and silver prices could have reached unimaginable levels. Steer asserts that once this manipulation ends, the market will continue toward new highs. Ed Steer emphasizes that the recent price drop is part of a wash, rinse, and spin cycle, a deliberate price suppression. similar to the adjustment in early April. While this phase may last longer and dip deeper, the end result remains the same. Prices will return to a strong upward trend. In April, silver hit a low of $27 an ounce and nearly doubled in a few months before being capped. Importantly, the silver shortage remains, even worsening. The LBMA recently ran nearly empty, forcing imports from multiple sources. As global supply is drained while demand rises, the market is temporarily compressed. Once the manipulation cycle ends, silver could surge strongly to unprecedented highs. Ed Steer emphasizes that the recent price drop is part of a wash, rinse, and spin cycle, a deliberate price suppression, similar to the adjustment in early April. While this phase may last longer and dip deeper, the end result remains the same. Prices will return to a strong upward trend. In April, silver hit a low of $27 an ounce and nearly doubled in a few months before being capped. Importantly, the silver shortage remains, even worsening. The LBMA recently ran nearly empty, forcing imports from multiple sources. As global supply is drained while demand rises, the market is temporarily compressed. Once the manipulation cycle ends, silver could surge strongly to unprecedented highs. Ed Steer warns that the LBMA cannot maintain the silver shortage much longer. With an annual shortfall of about 150 million ounces, within 2 to 3 months, LBMA may again face insufficient supply, forcing them to source more silver to avoid default. Major institutions and banks are closely monitoring reserves and market movements, while demand continues to rise. When supply is limited and demand increases, the silver market is setting the stage for a strong upcoming rally. Ed Steer explains that amid the prolonged silver shortage, major institutions are rapidly acquiring silver through ETPs and silver-backed funds. Lease rates and spot future spreads indicate a tight physical market. Meanwhile, major vaults and refiners report record-low visible stocks, highlighting the growing scarcity. When demand rises but supply cannot keep up, silver's potential price surge intensifies. Additionally, factors such as changing monetary policies, low real interest rates, a weak dollar, and inflation concerns elevate silver from an industrial metal to a key financial hedge. In this context, holding silver is not just an investment, but a means to protect wealth in an unstable economic environment.